Welcome to Triathlon Partners TV. This is Ira Koyner, the original IRA. Today, we are very excited at Triathlon Partners because we are announcing we will be issuing a custom structured note. That's right. If you're interested in this note, you got to stay tuned. We are the only people who will offer it. This is a custom note. I made it specifically for my clients because I think it's a fantastic way to play international equities. Now, everyone knows I've talked about structured notes a ton, and I've talked about international equities and how it's very important to diversify. And I've combined these things into something that has a fantastic risk return. So typically, the investors out there, like yourselves, are overexposed to the US markets. So we need to broaden your investments to have some diversification. That way, if the US markets aren't doing so well, other markets might be doing well, back and forth, uncorrelated. Your portfolio will remain less volatile, and over time, it will go up more consistently. So why did I pick this specific structured note? Well, Japanese equities is something that a lot of people are underexposed to. And there are a lot of things going on in Japan that are very, very good for the stock market. As well, valuations of stocks in Japan on a price to book ratio are between 1.2 and 2.0 compared to the US, which is much, much higher, well close to 3. Right. So from that standpoint, we think it offers a great opportunity. But one of the main drawbacks is the foreign exchange risk. Well, we've eliminated the foreign exchange risk with the Japanese yen by doing this structured note. This structured note is for the long-term investor. 5 years, 5-year note, long-term investor. You're looking to save to retirement. You're in your 20s, your 30s, your 40s, your 50s. This is something for you, right? Now, the way it works is the performance of the note is based on the performance of 2 indexes in Japan, right? And it's going to be on the least performing index. Those indexes are the Nikkei 225 and the Topix 100. Now, the Nikkei 225 is probably something most people have heard about. It's about the 225 largest companies in Japan. Some of the companies there are SoftBank, Uniqlo's parent company. And this index is heavily tech weighted, like the NASDAQ. 48% of the company, 48% of the index is made up of technology firms, as well as this is a price weighted index. Okay, it's very different to what is the Topix 100 index, which is the largest 100 stocks by market capitalization on the prime market on the Tokyo Stock Exchange. Companies like this are a little bit more familiar. They're Toyota, Sony, Mitsubishi Financial, and Nintendo. Now, the top 10 companies on this index only make up 18.4% of the total movement in the index, which is great because the NASDAQ and their top 10 are 52%, right? And as well as the Nikkei is about 40%, right? So these are they're slightly different indexes, and they offer something fantastic when we put it in the least performing one, right? And that might not sound attractive, but if these both indexes are positive at the end of the 5 years, the least performing index, you multiply their return by 2.65, and that's the return of the note. So if the index after 5 years is up 10%, that's very low, you will get 26.5%, right? If it's up 20% after 5 years, you will get 53% return on your money. So it could keep on going higher. It's always going to be 2.65 times, and there's no cap. Now, on the downside, what happens if the least performing index is negative, right? Well, this has a buffer. So if it's the least performing index is down less than 30% after 5 years, you get 100% of your principal back, right? If it's down more than that 30%, it's a 1-to-1 loss, right? That's just as if you're long the index on its own. So for instance, if the index is down 40%, then you've lost 40%. The index is down 20%, you're flat. So this is great. Now, why the advantage of the note over your typical investments in the Japanese stock exchange, right? Well, this has, we've talked about diversification of product and diversification that it's international stocks, two things you probably are underweighted on, as well as if you decided, I don't like the worst of it's language that's not so good. You bought each of these indexes on their own, and the indexes went up. You would indexes up 10%, you make 10%. Well, the index is up 10% and you long the note, you're going to be up 26.5%, right? Indexes are down 10%, you're going to lose 10% if you just own the indexes. With the note, you get your money back. And if the indexes are down 40%, well, you're going to lose 40% on either investment. So from this standpoint, this makes a lot of sense. It minimizes and takes away some risk, and it gives you upside return, and it doesn't add any extra volatility to your portfolio. So, okay, this is great. Thanks for tuning in. Once again, we're the only ones involved in the distribution of this note. So give us a call. We can give you more details about it. The bottom line is you're going to be investing in international stocks. You got to make sure your money's working harder for you. And a phone call to Triathlon Partners or reach out to us on our websites, and we can explain how we can make this happen for you. All right, take care, and please read the disclaimers on the bottom of the video. Take care. Bye. Have a blessed day.